Welcome back to Dinar Daily. Imagine a time just yesterday when the world of global finance seemed fixed, a closed circuit where only the most established currencies commanded the spotlight. Now, picture a dramatic dawn in the currency markets. A moment when the gates swing open for two currencies long considered exotic or restricted to regional trade: the Iraqi Dinar, or IQD, and the Vietnamese Dong, or VND. This is not a hypothetical exercise. It is the fundamental reality of the financial world today in 2025, a sudden and profound change where these two units of money are now widely available for global trading on major Forex platforms. This monumental shift dramatically alters the dynamics of how capital flows into the Middle East and Southeast Asia, inviting a new level of scrutiny and participation from traders, international corporations, and global institutions that were previously kept at arm's length. The implications for market structure, pricing efficiency, and international commerce are immediate and far-reaching, fundamentally rewriting the playbook for emerging market currency dynamics and opening up formerly inaccessible markets to millions of new participants worldwide. This development is particularly striking because of the history of restricted access associated with both currencies. The Iraqi dinar for years has been inextricably linked to the nation's powerful, yet structurally complex oil economy, often operating under stringent capital controls designed to manage domestic financial stability in a volatile geopolitical environment. Its trading outside of Iraq was largely confined to official domestic banking channels or limited, often unregulated regional exchanges, lacking the transparent, high-volume environment essential for mainstream international Forex activity. This insularity meant that international businesses and global macro traders had little practical mechanism for hedging or speculating on the IQD, keeping its movement relatively isolated from the daily pulsations of the world's major financial centers, forcing its valuation to remain mostly a reflection of domestic monetary policy rather than a globally traded price. This long period of restricted circulation has finally given way to a new era of open engagement with the global financial system. Similarly, the Vietnamese Dong has historically operated within a tight sphere of government regulation, primarily serving the needs of a rapidly modernizing, yet centrally planned, export-driven economy. While Vietnam's integration into global supply chains was undeniably deep, the Dong itself remained a primarily regional instrument, with its exchange rate tightly managed and its presence on the most influential international trading platforms being either non-existent or extremely low in liquidity. Foreign companies operating within the country often faced friction and higher costs when managing their Dong exposure, forced to rely on local bank arrangements rather than the efficient tools available for the yen or the euro. The lack of a deep international market for the VND meant that global capital flows related to Vietnam's impressive manufacturing output and burgeoning consumer market were often executed via US dollar or other regional currency proxies, hindering the full integration of the Dong into the global financial consciousness and limiting the nation's influence in setting its own currency valuation. The move to full listing on worldwide Forex platforms signifies that the IQD USD and VND USD pairs and their associated cross pairs are now available for purchase, sale, and hedging by any globally connected trader, fund manager, or corporation. This is far more than a simple regulatory change. It represents a functional, technical, and psychological watershed moment for both economies. The listing means that sophisticated algorithms and high-frequency trading systems, which previously ignored these currencies due to illiquidity, can now integrate them into their models, adding constant, deep flow to the order books. This new accessibility immediately democratizes the ability to participate, allowing retail traders using popular applications to interact with the same market mechanisms as institutional banks, fundamentally breaking down the barriers that once made these currencies a niche pursuit, paving the way for unprecedented levels of transactional volume and competition. The profound economic Reforms undertaken by Iraq are the foundational reason for the international financial community's newfound confidence. The country's concerted efforts toward economic stabilization and the significant reform of its banking sector have been instrumental in clearing the path for this listing. Crucially, Iraq's massive, verifiable crude oil reserves provide a powerful, tangible asset backing for its currency, ensuring a steady, albeit cyclical, stream of U.S. dollar-denominated revenue when global energy prices remain stable or rise. This commodity-backed assurance serves as a vital psychological comfort and risk mitigant for international financial institutions, reducing the perceived sovereign risk associated with the dinar. The increased transparency in central bank operations and a commitment to anti-money laundering measures have collectively bolstered international trust, demonstrating a long-term commitment to adhering to global financial standards. Simultaneously, Vietnam's own structural transformation has been equally compelling, solidifying the economic basis for the Dong's international debut. The sustained manufacturing boom, which has positioned Vietnam as a key global hub for high-tech production and diversified goods, has created a compelling narrative of long-term economic growth. Continuous, robust growth in exports has anchored the economy to global trade systems, generating reliable foreign currency earnings. The government's deliberate policy of loosening capital controls and facilitating foreign direct investment, FDI, signaled a clear willingness to embrace global finance, fostering an environment where a freely tradable currency became a logical next step. These incremental but significant monetary and capital mobility reforms have successfully elevated the Vietnamese Dong from a regional curio to a serious emerging market currency contender on the world stage. One of the most immediate and tangible consequences of this global listing is the dramatic increase in liquidity for both the IQD and VND. Liquidity refers to the ease and speed with which an asset can be converted into cash without affecting its market price. The influx of countless new buyers, sellers, and speculators creates a substantially deeper order book, ensuring that large volume trades can be executed swiftly without causing undue market disruption. This improved market depth translates directly into tighter bid-ask spreads. The difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. Historically, those dealing in these restricted currencies endured wide spreads and high transaction costs. Now, the competitive pressures of global Forex trading platforms will compress those costs, making transactions more efficient for everyone from institutional traders to the small business owner managing import costs. ****. This new trading environment also dictates that the Iraqi Dinar and the Vietnamese Dong will become far more acutely sensitive to global macro news and external economic pressures than ever before. In the past, domestic central bank policy and local political developments were the primary, and often only, drivers of their valuation. Now, with millions of global market participants having immediate access, these currencies will respond instantaneously to shifts in global interest rates, especially those set by major reserve currency central banks. Changes in commodity prices, particularly oil, for Iraq and broader geopolitical events that affect global risk sentiment. A hawkish statement from a leading economic power, a supply shock in the global oil market, or an unexpected trade policy change in a major trading bloc will now trigger measurable and immediate price reactions in the IQD and VND pairs, reflecting their deeper integration into the nervous system of world finance. To fully grasp the relative value of this new trading reality, it is helpful to anchor the discussion in the real numerical data, recognizing that currency values are inherently relative and reflect decades of historical economic performance. At the time of this global launch, the Iraqi dinar is trading at a rate where a large quantity of dinar units is required to equal a single US dollar, specifically near 1,300 IQD per one United States dollar. This high number is a function of past inflation, monetary policy choices, and economic circumstances that have unfolded over many years in Iraq. Similarly, The Vietnamese Dong is currently positioned where approximately 24,300 VND is needed to purchase $1. These substantial nominal figures are common in economies that have experienced prolonged periods of high inflation or specific devaluation policies. The critical change is not the number itself, but the nature of how that number is determined from a tightly managed, largely domestic calculation to a value that will now be continuously and openly adjusted by the sheer volume of global market flows, speculation, and immediate reaction to world events. For active Forex traders, this market liberalization instantly presents the IQD USD and VND USD pairs, alongside their various cross-currency permutations, as entirely new instruments for exploration. The early stages of trading in these pairs are ripe for the discovery of unique trading patterns and transient inefficiencies that naturally emerge when a new market is finding its footing. The low availability of historical institutional data and the initial, erratic behavior of newly liquid markets mean that seasoned traders may find opportunities ahead of the broader market, provided they adapt their strategies. However, this novelty is a double-edged sword, accompanied by significant unpredictability and a lack of established price action context. Caution is paramount, as the historical models and indicators used on major currency pairs may prove unreliable in this fresh landscape, demanding a prudent, humble approach to entering these nascent global markets. Prudent risk management is non-negotiable for anyone considering participation in these newly tradable currencies. The early market phase will likely be characterized by heightened volatility, and while this creates opportunities for movement, it simultaneously multiplies the potential for rapid capital erosion. Traders must maintain small position sizes initially, only deploying a fraction of their standard capital to observe how the markets breathe, how they react to data, political events, and commodity price swings. It is also crucial to scrutinize the technical execution provided by their chosen broker, paying close attention to real-time slippage and the actual spreads during different market sessions, recognizing that the liquidity profile of the IQD and VND may still be uneven compared to the G7 pairs. For institutional and long-term global investors, the listing of the IQD and VND offers a valuable new dimension for portfolio diversification. An investor with a positive outlook on the future of Iraq's oil production and its eventual economic modernization now has a direct mechanism to gain exposure to potential currency appreciation rather than being confined solely to equity or fixed income instruments. Similarly, those who see Vietnam's continued manufacturing-led growth trajectory as a compelling long-term theme can now incorporate a currency position as a core component of their exposure strategy. A strengthening dinar or dong, fueled by robust economic data or increased capital inflows, could serve as a valuable alpha source, adding appreciation potential to international investment portfolios that previously lacked a direct currency hedge or speculative avenue in these regions. However, the investment landscape for emerging market currencies is notoriously fickle, and the newfound tradability of the IQD and VND does not eliminate the inherent risks. Local political instability, a sudden reversal in policy decisions by the central bank, or unexpected economic shocks such as a geopolitical conflict or a significant drop in global oil demand for Iraq can trigger brutal and abrupt currency movements. Moreover, the risk of external contagion from broader emerging market crises means that a financial panic, originating in a completely different region, could still cause capital to flee. The Dinar and the Dong investors must approach these currencies not as passive holdings but as dynamic portfolio elements, mandating continuous review, clear stop-loss orders, and a deep current awareness of evolving macro trends in both the respective countries and the global financial environment. The ramifications of this shift for international businesses and global trade are profoundly practical, simplifying and improving the mechanism for financial risk management. Consider a major Vietnamese exporter shipping millions of dollars worth of goods to a foreign market. previously finding liquid, cost-effective instruments to hedge their dong exposure against a sudden appreciation or depreciation might have been challenging or prohibitively expensive, leading to uncertainty in profit margins. With the global listing, this exporter can now utilize widely available, efficient Forex tools like forward contracts or currency options tied directly to the VND, providing greater certainty and allowing for far superior, more precise financial planning. This translates directly to increased stability and confidence in international pricing, promoting smoother trade flows. Similarly, an Iraqi business engaged in large-scale imports of machinery or specialized foreign services, which must pay its international contracts in US dollars, now benefits from this market depth. Access to readily available, market-based instruments to hedge against IQD fluctuations helps mitigate the risk of sudden, unexpected cost increases due to currency depreciation. This ability to reduce losses from unforeseen currency swings is a powerful incentive for international businesses and trading partners to increase their engagement with both countries. In essence, the global financial risk inherent in conducting business with these nations has been made more manageable, paving the way for lower transactional friction, enhanced profit predictability, and a more competitive environment for trade. This financial liberation extends its benefits beyond large institutions to affect individual travelers and remittance senders. For anyone sending funds to family in Vietnam or Iraq or exchanging money for tourism, the increased competition and liquidity generated by global trading is expected to result in tighter spreads and demonstrably better conversion rates. The necessity of relying solely on limited, often high-fee intermediaries or unofficial channels is reduced as mainstream financial platforms compete for volume. This democratization of currency exchange means everyday people will be able to transact more directly at rates that are competitive with the global market, effectively shaving off significant costs and eliminating the friction that previously penalized small, frequent cross-border transfers and casual currency exchange for individual needs for active traders navigating these new markets. The timing of trading activity will matter immensely, dictating where and when the deepest liquidity and greatest volatility will be found. The VND pairs are likely to exhibit their most active periods during the Asian market session, coinciding with the working hours of Vietnam, its major regional trading partners, and the financial hubs of Singapore, Hong Kong, and Tokyo. Conversely, liquidity and interest in the Iraqi dinar may be concentrated during the Middle Eastern and European sessions, reflecting Iraq's time zone and its primary trade relationships. However, the crucial periods of heightened volatility and maximum global flow will likely occur during the overlap hours between the European, London, and early North American trading sessions, when the greatest concentration of international capital is simultaneously engaged in global market activity, necessitating a session-aware approach to risk. A comprehensive view of these markets demands an acute recognition of the distinct risk factors associated with emerging market currencies. Both Iraq and Vietnam operate within dynamic, sometimes fragile, political frameworks. The risk of sudden political instability, unexpected cabinet reshuffles, or abrupt policy shifts remains a primary concern, capable of triggering instant and severe currency movements. Furthermore, the data release schedules for key economic indicators may not be as standardized, robust, or reliably predictable as those of developed nations, making fundamental analysis more challenging. The overriding influence of commodity prices, specifically the price of oil for the IQD, and the prevailing global risk appetite mean that these currencies are often merely a reflection of external factors, rather than purely domestic economic strength. A very practical, technical risk to acknowledge is broker risk. The sudden listing of the IQD and VND means that not all Forex platforms will have the same level of comfort, liquidity relationships, or experience in handling these new pairs. It is highly probable that execution quality, spreads, leverage offerings, and margin rules will vary significantly between platforms. Some brokers, particularly smaller ones, may initially impose restrictions on trade sizes or struggle to source sufficient liquidity during volatile periods, leading to unexpected slippage. Before any live trading, a thorough examination of the broker's specific terms for these new pairs, including a review of their historical data feed and the stability of their execution during high-volume periods, is an essential, foundational step in due diligence for individuals or institutions seriously contemplating engagement with the newly available IQD or VND pairs. A structured, step-by-step approach grounded in research is vital. The first step involves an intensive, dedicated study of Iraq's core economy, including its national debt profile, the sustainability of its oil revenues, the trajectory of its political stability, and the mandates of its central bank policy. A parallel research effort must be undertaken for Vietnam, focusing on its trade balances, the speed and scope of its manufacturing growth, its domestic inflation figures, and the policy mechanisms governing foreign direct investment, FDI, and capital flows. Success in these markets is inextricably linked to a deep understanding of their unique and evolving fundamental drivers, extending far beyond simple technical chart analysis. Following the fundamental research, it is highly advisable to initiate participation using a demo account or a real money account with only an extremely small amount of capital. This phase is dedicated to practical experimentation and testing of the new market dynamics, allowing the user to experience the nuances of order execution, measure the actual slippage encountered, observe the typical spreads under different conditions, and quantify the true volatility of the pairs in real time. This iterative, controlled testing phase is crucial for building a pragmatic understanding of market behavior, identifying potential broker-side friction, and refining the execution strategy before committing any significant capital to the live trading environment, transforming theoretical knowledge into practical expertise. The core of any viable strategy in these emerging markets must be robust, disciplined risk management. Given the high volatility inherent in these newly integrated pairs, position sizing should be constrained to limit exposure to a very small, predefined percentage of trading capital. The consistent application of stop-loss orders is critical to safeguard against abrupt, unfavorable price movements that can characterize emerging market trading. Furthermore, establishing a system of alerts for key macro data and news from both countries is essential. Since public information may be less frequent or reliable than in developed markets, the quick integration of political or economic event data into the trading strategy can provide a crucial advantage in anticipating market shifts. In analyzing the prevailing sentiment from financial experts and market commentators, a pattern of cautious optimism emerges regarding this market expansion. Many analysts view this as an overwhelmingly positive step, celebrating the increased integration and liquidity it brings to emerging market currencies, which is a necessary precursor for a sustained foreign investment. The ability for investors and businesses to now more effectively manage and hedge currency risk is seen as a key enabling factor that will likely attract more substantial international capital flows over the long term. However, this optimism is tempered by the collective experience that emerging market currencies are inherently among the most volatile and risky asset classes globally, emphasizing the need for disciplined caution and extensive ongoing research into country-specific risks, underscoring the universal agreement that this is an opportunity accompanied by substantial potential volatility. To concretize the potential implications of this global access, one can project a few plausible near-term scenarios. Imagine, for instance, a situation where the next quarterly Vietnamese export data is announced to be significantly stronger than all analyst expectations, accompanied by an unexpected surge in foreign capital inflows specifically targeting the manufacturing sector. In this scenario, the dong could experience a sharp, sustained strengthening against the dollar, validating the bullish thesis and providing substantial appreciation gains to those who hold the currency or have structured trades to capitalize on such fundamental surprises. Conversely, a scenario where Iraq is gripped by unexpected political unrest or where a major global downturn causes a sharp, prolonged decline in oil prices could trigger a swift and severe tumble in the dinar's value, catching unprepared investors. off guard and highlighting the immediate, non-linear reaction of this new market to geopolitical and commodity risks. A different yet equally impactful corporate scenario involves a major international technology firm with established operational footprints in both Iraq and Vietnam, receiving revenue and incurring costs in local currency. With the newfound global trading access, this company is now empowered to hedge its cumulative currency risk with far greater precision and at a lower cost than previously possible. The reduced cost and increased effectiveness of this currency risk mitigation translate directly into better profit margins and greater stability in reported earnings. This financial certainty, enabled by the listing of the IQD and VND, serves as a powerful magnet, making those markets more attractive to other foreign businesses and, in a virtuous cycle, potentially fueling further foreign direct investment and broader economic development within both nations. To conclude this discussion, let's focus on the key factors to watch in the coming days and weeks as these currencies fully integrate into the global landscape. The initial period will be defined by volatility, and market observers should anticipate large swings as new money flows digest the initial information and technical setups. Closely monitoring the official macro news releases from both the Central Bank of Iraq and the State Bank of Vietnam, including interest rate decisions, inflation reports, and official trade balances, will be paramount. For Iraq, the price and stability of crude oil will remain a dominant external influence. More broadly, watching the overall global movement in risk appetite, whether the market is in a risk-on or risk-off mode, is critical, as emerging market currencies like the IQD and VND tend to benefit during periods of increasing global risk tolerance and suffer as capital rushes back to safe haven assets. Finally, it is essential to monitor the inevitable adjustments in broker offerings across the global ecosystem. As market volume stabilizes and liquidity pools deepen, various Forex platforms will recalibrate their operations. This means that spreads and margin requirements for the IQD and VND pairs will likely change periodically, reflecting their new, more stable liquidity profiles. This global launch of the Iraqi Dinar and Vietnamese Dong on major Forex platforms represents a true watershed moment, transitioning two formerly constrained currencies into the dynamic, high-volume sphere of global finance. This change opens vast new avenues for traders, investors, businesses, and individuals, but it simultaneously imposes a strict requirement for respective risk and an unwavering commitment to education and cautious, data-driven participation. This is a significant development, and those who approach it with diligence will be best prepared to navigate the complexities and potential opportunities of these newly tradable markets.